Stars are a combination of long real bodies and spinning tops. Or put another way, a star consists of a small real body which gaps away from a long real body. The color of the small real bodies is not important. In each case, their quiet action indicates that supply and demand are finely balanced. If a star appears after a relatively protracted rally or reaction, it indicates that the previously prevailing bullish or bearish forces no longer have the upper hand, so a possible trend reversal may be in the offing. Stars come in four principal varieties: morning, evening, doji, and shooting stars. Let's begin with the morning star. The morning star is said to begin a new day of hope and is therefore bullish. These patterns are formed with two long real bodies separated by a spinning top. Here's the first candle. The second star is the spinning top, which is made with a gap, or put another way, a price vacuum between the close of the first real body and the upper part of the real body of the spinning top. It's also possible for the star to open a window, or gap, by falling completely outside of the entire trading range of the previous black candle. The first real body should be black. The color of the star is not important because it reflects a marginal battle between buyers and sellers following a sharp trend where sellers have dominated. The color of the third candle is important, for if it's to signal a reversal from seller to buyer dominance, it should reflect this with a white candle. It should also have a gap between the real bodies and should close above the halfway point of the first real body. Here's that halfway mark, and you can see that the close of the confirming white candle is above it. The more it can close into the first candle's real body, the stronger the effect. Volume's also a contributing factor and should ideally be heavy on the third candle. Dramatically lower activity is a sign that the pattern might be suspect. The evening star is the reverse of the morning star. It too consists of three candles: a long white body separated from a black real body by a spinning top. The real body of the spinning top should also fall outside of the real body of the first candle. Even better if there's a gap on both sides of the star. Finally, the third candle should close more than halfway below the midpoint of the first, that is, below the horizontal line. Technicians usually like to see a confirmation of the star. In the case of a top, this would take the form of a long, dark real body. It's normal in a declining trend for volume to contract, so an increase, as in this example, is abnormal and more bearish, since it reflects motivated sellers. A doji star consists of a long real body followed by a small doji. You may recall that a doji is a candle in which the opening and closing prices are more or less identical. A doji star offers a warning that a trend is about to reverse. The long real body should be colored in the direction of the then prevailing trend. In other words, if the prevailing trend is up, look for a white real body. If the prevailing trend is down, look for a dark real body. The doji should gap outside of the first candle's real body. Note that the trading range for the doji candle is very small. The real body on the third candle should be the opposite color to the first. In other words, an evening doji star, as shown here, would have a black real body on the third candle. In this example, we see a morning doji, where the decline ends with a long black candle. The doji real body gaps down, and the third white candle ideally gaps up and closes above the halfway point of the first one. The same rules of significance relating to the third candle volume and the third candle closing, discussed for regular morning and evening stars earlier, also applies to the doji variety. In other words, for reversals of downtrends, look for heavy volume on the third candle, and for a closing that develops above the halfway point of the first candle. Candle tops are emphasized when they're associated with heavy volume. The third candle should also close well into the lower half of the first candle's real body. Other things being equal, the doji stars are more significant than regular morning and evening stars, and this is because their narrower real bodies represent a finer balance between buyers and sellers. Consequently, when this battle is resolved, the signal is much stronger. There's one other point concerning significance, and that is if the doji candle is completely separated from the other two candles, in other words forms a kind of island where not even the shadows overlap, this is a much stronger signal than if the shadows do overlap. In Western chart language, we'd call this a one-day island reversal, since the entire trading range forms a kind of island. The official candlestick terminology for such a setup is an abandoned baby. While abandoned children appear at both bottoms and tops, they're fairly rare. Here we see a bullish abandoned baby, if it's ever bullish to abandon a baby. This diagram shows a bearish one. See how the baby is totally separated from the other two shadows on either side. One hint that a doji star may not be working occurs when during a downtrend the third candle gaps below the doji, and the color of this candle is black. In such instances, the bullish implication for the doji is invalidated. The opposite would be true for top, in that the third candle gaps up from the doji candle, and the color of that candle is white. The moral of the story is that once a bullish doji has been spotted, it is equally important to wait for the third and fourth candles to make sure they confirm the positive implications of a morning doji. The same, of course, would be true for potential bearish formations. Finally, we turn to the shooting star. This is a short-term top, where after an advance, the price action usually creates a small gap, and a small real body appears at the lower end of a long wick or upper shadow. In a sense, it's a kind of reverse hanging man. The color of the star is not important, though the presence of a good gap and the long upper shadow emphasizes the significance of the candle. A shooting star indicates that the price opens close to the low, then rallies in a very impressive way. However, the rally falters and prices end the session at or very near to their opening level, depending on the color of the real body. It's a very disappointing candle, since the higher prices during the middle of it are not sustained, and all those traders who bought during this period go home taking a loss. When a shooting star appears after a price decline, it's known as an inverted hammer. And that's because that's what it really is. The formation is the same as the shooting star. However, because it appears after a decline, its implications are bullish. The key, once again, is the small real body compared to the long shadow. The color of the inverted hammer is immaterial. It is a bullish candle, but it is of paramount importance to wait for some kind of a confirmation in subsequent sessions. This could take the form of a white candle with a higher opening the next day, that is, where the real body gaps up from the inverted hammer's real body. But generally speaking, the wider the gap, the stronger the confirmation. If this candle also turns out to be a long white real body, so much the better. Usually, the longer the price is able to hold above the real body of the inverted hammer, the greater the odds that a bottom has been formed. On the face of it, the inverted hammer candle looks bearish, since the bulls are unable to sustain the rally and prices close near or at their low for the session. Therefore, confirmation is important. Obviously, there are a lot of traders who look at this action and then go short. Consequently, if on the day of the confirmation the price opens higher and then continues to rally, events are not working out in the way the shorts anticipated. As a result, they cover and add fuel to the rally. It's not so much that the inverted hammer is bullish, it's more of the combination of a bearish scenario which is invalidated by the bullish confirmation. You may recall that a doji is a candle in which the opening and closing prices are more or less identical. The example shown here is known as a long-legged doji. In a way, it indicates indecision, since prices fluctuate greatly throughout the day, as can be appreciated from the long shadows. However, at the end of the day, the price returns to its opening level. The long-legged doji therefore has no forecasting value, except to say that when it appears after a sustained rally or reaction, it indicates a closer balance between buyers and sellers compared to the previous sessions when one or the other was clearly in command. Therefore, be on the lookout for confirmation of a reversal in the subsequent candles. Note how the black candle following the long-legged doji opens below the doji and closes well into the real body of the white candle which preceded it. Another variation shown here is the gravestone doji, where the opening and closing prices occur at the low. And that's quite bearish. We typically see it at the end of an advance, where the upper shadow represents new high ground for the move. The fact that prices end the day at the opening after all that work at higher levels is indicative of a change in psychology, and it's really a sign of buyer exhaustion. In this case, the longer the shadow, the more negative the omen. In the strictest sense, a doji ends the session at the same price it began. However, a more lenient interpretation would allow some leeway in that the opening and closing prices, while not exactly identical, still end up extremely close together. The distinction is quite subtle. When bending the interpretation, always bear in mind the basic underlying psychology that a doji is trying to reflect, and that is a session which ends up in indecision. What constitutes the difference between a liberally interpreted gravestone doji and a shooting star with an extremely small real body and unusually long upper shadow can be a moot point. However, the effect of both types of candles are very similar. Basically, the closer the opening and the closing prices, the more powerful the omen. This principle applies to all forms of doji and is not limited to the gravestone variety. Another way to judge how wide a tolerance, if any, should be given to the difference between the opening and closing prices is to relate the doji to previous candles. If they've got small real bodies, as in this chart, then go for a strict doji definition. On the other hand, the preceding candles have particularly long real bodies. This allows a little more latitude. In this instance, the integrity of the idea that supply and demand are in balance has not been violated, because proportionate to the previous session's trading ranges, the open and close of the doji candle are relatively close. As discussed earlier, a doji merely points out that there is a balance between buyers and sellers. It marks a caution flag on the field so far as the current trend is concerned and must be confirmed. If it's not, and the price moves higher, then the balance is once again resolved in favor of the buyers. Here, the doji appears after a long black candle. At this point, it would have looked as though the trend was about to reverse. However, the next candle was a relatively long white candle, which took the price higher. This, in effect, told us that the standoff between demand and supply, as reflected in the doji, had been resolved, only this time in favor of the buyers. The appropriate place to have placed any short stop would have been above the high of the doji candle. Remember, a regular doji by itself is not sufficient evidence to take action, so this is a fine example of why waiting for confirmation of a trend change is an insurance policy well worth paying.